Hey, everybody. Welcome to SmallCapSteve Live. I'm SmallCapSteve. Today we're going to be talking some ETF investing, gold, macro. Elon bought a bunch of Bitcoin. Maybe later on in the show, we'll get into some Canadian microcap news. So buckle up. Let's get started. Day after the Super Bowl. Jason, sweet Jason, can you hear me?
I can. I'm here. How's she going this morning?
I'm doing
I
fantastic.
know you're hungover.
I'm very hungover. I had a couple friends over. We broke not just two friends that are very isolated, and we celebrated last night watching the Super Bowl, watching Tom Brady. Today we got a last minute guest that joined us, which is great. We got Rhind joining us, and he's got a lot of great hot takes on things macro that we love to cover. Will, can you hear us?
I can. Yeah, great to be on. Thank you.
Thanks so much for joining us. Did you watch the Super Bowl last night?
I did indeed. Yeah, it was a good game. I guess if you're a Tampa fan.
Yeah. Who were you rooting for?
Well, I was rooting for Tampa. So the connection is that the owners of Tampa Bay Buccaneers also own Manchester United. So I'm a huge Manchester United fan. So that was my connection to it.
Okay. Awesome. There's something about watching Tom Brady just defy, what should happen as you get older and still be. And then like Gronk's just so likable, right? We sat around and watching YouTube clips of Gronk with a couple buddies for like an hour after the game, just laughing our heads off. It was a fun game last night, I guess.
Yeah, it's pretty amazing considering that. This is just one season. I read a stat saying, I don't know if it was right or not, saying that the Tampa Bay Buccaneers were the worst team in the league before Brady joined, and the Chiefs were the best. Over the course of one season, how he's kind of managed to turn that around is pretty impressive.
Yeah, it's definitely, so first thing we want to talk about here. Well, I don't know. Look, I can talk about sports all day, but I know
Steve can, and I'm not a sports guy, so that's why I'm just sitting here smiling.
all that Jay cares about are filings, financial statements, income statements, balance sheets. This is what he loves. So that's his Super Bowl, is every Friday night when companies try to sneak through bad news releases. He's sitting around drinking some wine and waiting for those financial statements to get updated or bad news releases. So he's not a sports guy, but I love it. Anyways, so let's start off at the top here. Elon Musk. There was some news there. Jay, do you want to break down the news with Elon?
Yeah, it's nice and quick there. So Elon Musk, his company Tesla, filed this, I think it was early this morning, that they actually have $1.5 billion in Bitcoin holdings. This follows some internal regulations that they changed last month, which enables them to buy digital currency as well as gold and gold-backed ETFs. So Bitcoin has been on a bit of a run this morning following that.
Yeah. So Will, do you guys have ways that investors can get exposure to Bitcoin?
We don't actually have any way to get in Bitcoin. You may not be aware, but this has been a huge thing in the US, like over the last couple of years. It's been a big arms race, if you want to use that analogy, to try and be the first to get a Bitcoin ETF to market. We've certainly been one of the companies that has tried to do that, but ultimately the regulator said no, and so it's a kind of wait and see approach. So no Bitcoin ETFs right now in the US market, but hopefully that will change sometime soon.
Okay, so talking Bitcoin, do you think that we'll see a central bank, like a G7 kind of central bank, buy Bitcoin at any point in the future? I know that's like you don't have a crystal ball, but what's you clearly, like you're out of New York, right?
Yes, that's right. Yeah, I'm in Manhattan.
So you're talking to a lot of institutional grade investors. What do you hear when Bitcoin comes up?
Well, I think people are really fascinated in it, and in many ways, it's similar to other non-equity and bond investments. So it's like gold in many ways, in terms of it's an asset that people like to trade. It's an asset that has some store of value properties. It's also not correlated to stocks and bonds. So kind of going back to your question, I think there will be other people that will start to buy Bitcoin that haven't bought Bitcoin up until this point. And although maybe people might argue Tesla is a different case because of Elon Musk himself, but think about that. That's a Fortune 500 company that has just bought $1.5 billion worth of Bitcoin. It's really extraordinary if you think about it. Very rarely will we hear of any kind of S&P 500 corporate treasurer buying anything or holding anything other than cash or kind of very, very conservative bonds.
That's a really interesting point, and it's something that I think about a lot with all of this, monetary easing and government debt, and how do you go get yield in today's market? That you hear of, like you said, like a Fortune 500 kind of company just park a bunch of capital in Bitcoin. Like, is this the new normal?
I don't know if it's the new normal. I think this is certainly abnormal at this stage, but who knows if it's the start of a bigger trend. I mean, going back to your point on central banks, we had the Japanese central bank that for a number of years, particularly since the advent of so-called Abe economics, they went into the market and bought ETFs. So they were one of the only central banks in the world that I'm aware of that were actively buying ETFs, and they were doing that because they were trying to stimulate demand for the equity market, trying to get inflation going in their economy. But that in of itself was very unusual, and so now obviously with this Bitcoin Tesla news, I mean, who knows? It might be the start of a broader trend of people really getting into the market and buying different assets than they would have in the past because the Fed and other central banks have sucked all the income out of the markets.
Mm-hmm. Yeah, it's really, when I look at Bitcoin, my take on it is it just seems like they keep getting these little events that are gradual that will lead to that event, and that's the big event to me. That's the Super Bowl for Bitcoin. Is we hear that a major central bank takes a position in Bitcoin, but like hearing that Tesla put $1.5 billion in Bitcoin, that's a big win for Bitcoin holders, and that's just another point of credibility for I don't know what you call an asset class, I guess, that leads to that event.
I think it's also, Steve, is the power of network effects today, and it's very difficult for people to really sort of think about that in a sort of traditional construct, and the network effect of somebody like Elon Musk, as we've seen, and it's not just about Bitcoin. I mean, it's been various other things. I'm a supporter of this, or I like this, and you get this huge network effect on the back of it. I mean, look at what happened to Reddit, or at least the traders on Reddit in the last couple of weeks with stocks like GameStop and AMC, etc. And this is kind of part of this phenomena of the network effect now and the power that these things have, where if people all coalesce around one particular idea, it can be very powerful. It can move markets.
Mm-hmm. So, talking about GraniteShares, your ETF, do you guys sit around actively and just talk about different ETFs that you want to start? Like how much of a conversation is that for you guys, or how focused are you on sort of what you're currently managing?
Well, in many ways, we're no different to any manufacturer. So it doesn't matter whether we're manufacturing widgets or ETFs. I think the process is fairly similar. And for us, it's two things. One, we've got to try and understand and try and predict, what demand will be like for certain products in the future. In many ways, that's more, you're an ideas-based company, because you're only as good as the ideas you put into market, because if there's no demand from investors, then you're not going to have a successful fund. You're not going to make any money. So really, the first part of what we do is obviously ideas, and we try and think about the types of funds, the types of exposure that people want to get exposure to, and bring them to market. Second part of it is obviously trying to make sure that that thesis is grounded in some sort of reality, and that's where we'll solicit feedback, much more like a traditional sort of focus group type thing from investors, saying, hey, if we did this, would this be a good idea? Would you have demand for something like this? So it's a mix of the both, but yeah, we absolutely spent a lot of time thinking about what new products to launch.
Have you guys had any conversations about starting like a YOLO ETF? I know that there is a YOLO ETF that's called YOLO that I think is a cannabis ETF,
Yeah,
but
that's right, cannabis.
where like you just pour in stocks that have social media traction. Is that a conversation you guys have had?
Yeah, no, I mean, the latest one would be meme stocks.
Okay.
So, there's been a huge amount of interest in people saying, hey, what is a meme stock? To people saying, hey, can you launch a meme stock ETF? And this is obviously all the back of, what's happened the last couple of weeks. And, while I'm not going to say we're categorically not going to do it, one thing that's really important to us is the ideas have to have longevity. So it's got to be something that it might be interesting now, but is it interesting in 5 years' time? Is it something that has staying power? And that's really important because we've got to build a fund which has longevity and that can sort of outlive just a short-term phenomena or fad. So that's something that we really think about.
I think a meme stock, or sorry, a meme ETF would also be difficult to manage in the sense of that's a lot of time spent on social media managing things. I mean, you can have the standard Tesla and stuff, but people would expect exposure to events such as GameStop, which means money is suddenly pouring in instantly, and then you got to get it out right away. And I can see it being a massive headache from that perspective.
Well, it's also, like you said, I mean, to the extent that these things are unpredictable, how predictable can it be? Because, it's easy for everybody to jump up and down and say, well, with hindsight, it's easy to predict that there'll be enough interest in GameStop to go higher. But I don't think that's the case because the whole reason it was a great story was it caught, majority of people by surprise in the market. And so from that perspective, when you're building a fund, how would you realistically anticipate what are these companies that are going to be of most interest next? And people will point to short selling lists and things like that, but that doesn't mean in of itself that those companies will end up, capturing that sort of retail investor zeitgeist.
Mm-hmm. I've asked you this before offline. I think cannabis ETFs, where our audience loves cannabis stocks. And generally, we make a living out of just calling out the bad actors in the space because there's so many of them. I know that there's a bunch of cannabis ETFs out there. Is there any plans for you guys to get involved in that space?
Not at the moment, Steve. I mean, the main reason is that cannabis is already a market that's pretty well covered in terms of market access. So I think there are like 7 ETFs currently in the US. So for us to be the 8th player is probably not that helpful to people. I think for us, the angle would be to try and target specific areas of the market once it gets more developed. And obviously, there's been a boost to that market with the incoming new president here. And so, people a bit more bullish on the sector, thinking that now it will become, really legal and there'll be proper capital put into the industry. And so I think at that point, there'll be more opportunities to perhaps launch ETFs that are focusing on specific areas of the industry, like you have in more developed sectors.
So what's the bread and butter to GraniteShares? Like, what are your main ETFs and what are they focused on?
Yeah, so there's 3 things we do. We do commodities. So within the commodities sleeve, we have a broad commodity ETF, that's COMB. That just gives you exposure to the 20 to 23 most liquid commodities in the world. Then we have gold. So gold is our biggest fund by quite some way, actually. The ticker code is BAR, B-A-R. And that's just giving you exposure to physical gold, probably the lowest cost way people can get access to physical gold in the ETF. And then we have platinum, which is PLTM. And again, platinum, exactly the same structure as gold, but just giving access to another metal. We have high income. So we offer a strategy that gives around about sort of 9-10% per annum level of income, so really high level of income. And then large cap equities, so a US equity strategy. And the idea there is called X-out, is to exclude the losers as opposed to focusing on picking winners. And we think that this particular market, there's never been a better example of a market that's bifurcated into winners and losers. And the best thing for investors to do is to focus on leaving those companies out of the portfolio that are most at risk.
So gold and platinum, are you actually holding physical?
That's right.
I mean, it's been a common theme, especially with silver, right? You've seen online at least, the difference between PSLV and SLV, and people saying one's better than the other. So you're actually holding the physical then on those?
That's right. So they track the spot price, hold physical bars. On the gold side, we hold LBMA, that's London Bullion Market Association. They're called good delivery bars, but they're 400 ounces roughly in size, and we hold those in vaults in London. And you can see on GraniteShares.com, which is our website, you can see the actual bar list. And each bar has a sort of birth certificate, if you will, but it has the serial numbers of the bars and other information, and we publish that on a daily basis. It's exactly the same for platinum, although the process for platinum is a little bit different in that you don't have the same size of bars, and you actually hold plate and ingot, and we hold those again in London in the same way. But fully transparent, you can see all the holdings on our website, and those vaults get audited 2 times a year. So there's actually people coming into the vault and checking the bars against the stock list that we hold.
How do the mechanics for that work? So if I buy I'm a retail investor. I'm the butcher, the baker, the candlestick maker. I invest $1,000 into the physical silver ETF. How do the mechanics work for the actual ETF? Do you guys go and buy more physical, or is there like a date where you sort of clear out the ledger? How does that work?
So a good analogy I always think is a bit like a warehouse, and we're running, obviously it's a vault, but a warehouse is kind of a good example where if you put inventory into the warehouse, you get a receipt for that, and then if you want to get it out of the warehouse, then you give back your receipt and you take your goods back. And it's a little bit like that. So on a daily basis, the share price that you see, that's a share which is backed by a specific amount of metal. So in the case of gold, for example, in our bar ETF, that's 1/100th of an ounce of gold. So just whatever the spot price is, roughly divided by 100. And so you see a share price that's currently around $18, $19 a share. So when you're buying that, that's backed by $18 or $19 worth of gold. And we at the fund accept what they're called creation baskets. They're basically large orders where a authorized participant or professional investor, broker, market maker creates gold in size. So they give us a large amount of gold in size. In return, we give them a large amount of shares that back that gold, and then they use those shares as inventory to offer to people on the secondary market, which is the stock exchange. So that's basically how it works. And then people trade those shares on a daily basis. And if there's a point where there's more demand than there is supply, then you need to create more shares. And so a gold ETF or silver ETF or platinum ETF, think of them as almost like stocks in continuous IPO. So you can issue more shares at any given time, obviously providing you have the underlying metal in the vault to back it.
So theoretically, I don't know what your take on the whole silver short squeeze is, but but if the mechanics to force some sort of a silver short squeeze are that we have to be demanding the physical, this ETF's a great way to try to push that strategy through. Theoretically, if you are like a whole bunch of people on Reddit and you think that you can create movement with numbers, and your goal is to, rather than I don't want to order the stuff in the mail and have a bunch of silver bars show up at my front door, and then my wife's gonna be like, well, what are we gonna do with all the silver? And I don't know. So instead I could just invest in an ETF. It makes a lot more sense and it's a lot easier.
Yeah, so maybe start from first principles. I spoke a lot about this last week because obviously we had the silver sort of Reddit phenomenon. But the first principle, the reason why ETFs are so popular is because what an ETF did was allowed you to own silver in a portfolio, or own gold, or own platinum in a portfolio. And just like people are saying, with Robinhood allows people to put the stock market, in your pocket, it's the same thing. It doesn't mean that it's a better or worse replacement for physical silver or physical gold, etc., in your house. It just does a different job. So if you want to put a metal like gold in your portfolio, you have to be able to buy it as a security. And the only way you can do that is an ETF form. Anything else is having you actually physically take gold, arrange storage it yourself, and that's fine for some people, but the majority of people just want a point-and-click solution, and that's what the ETFs do so well. And by the way, it'd be the same thing with Bitcoin. There's a reason why everyone wants a Bitcoin ETF. It's because it's not because they can't buy Bitcoin today. It's because they want to own it in a portfolio, and they want to have it in their Fidelity account or Schwab account, whatever, along with all of their other investments. That's the key.
Yeah, I think people are inherently like it's a time thing. Like, do I want to spend 3 days researching how to buy Bitcoin and like, oh, like you always hear these stories
opening an account with somebody. You got to go to a third-party vendor, open an account, do all the KYC, etc., versus your brokerage account, which you already have, and you just point and click.
Yeah, and like you hear these stories of like people who had a bunch of Bitcoin and then they threw out their computer and now they're like looking through the dump from a computer that they threw away 6 years ago. It's a lot easier to just buy through your discount online brokerage or however you trade stocks. Just go and buy into an ETF. That makes a lot of sense. Okay, so you see a lot of macro activity in investing, right? Like inflows, outflows into different sectors. What are you seeing today?
So today is just one of those days where everything is up. So we've got the Bitcoin and the precious metals. We got energy. We just talked about. I guess we didn't talk about energy, but with the oil price making new highs, so the commodity sector is looking really good, along with Bitcoin. But the broad market, it's up on the back of the stimulus package that looks like stimulus package 1.9 trillion, another multiple trillion package getting agreed. And so that just adds fuel to this fire. So we have major indices across the market making all-time highs again today. So it's just one of those days where everything's up. I think the only thing that's down, I looked, was the 10-year. So it just shows you that this is very much a risk-on environment, and people are buying the market pretty aggressively.
Yeah. So we're a small cap platform. We love micro caps. We love small caps. And like it seems like from our perspective, there's just a ton of money flowing into, like, some of these names are like actually like they're well known to not be great names, and they're raising a ton of capital. We're seeing just a ton of money pour into the sector, things that we took a flyer on that we never thought would get to this point in our wildest dreams. Are you seeing that with small caps, and do you think that continues?
Well, yeah, because I think what we're seeing right now, and particularly obviously in a day like today, where some of the most popular names of the pandemic, I'm talking your Amazons, your Zooms, etc., are actually down. And the reason for that is because energy on a day like today is one of the biggest winners with the oil price up. But I think it's the biggest story, or the bigger trend here. What you're saying, Steve, is that there's a rotation, at least on a short-term basis, into these sort of names that were perhaps worst or most affected by the pandemic. Areas of the market that were really had suffered catastrophic demand destruction. In terms of energy, travel stocks, some of the consumer staples, etc. And so I think what we're seeing is a bit of a rotation now, and maybe with more confidence, both in terms of the stimulus coming into the market and with the vaccines, and people thinking that we'll get back to a sort of state of normal sometime soon. People are having more confidence to buy those stocks, and they're being bid at the moment.
How much do you think the stimulus is baked into the market? Like, obviously, again, you don't have a crystal ball or anything, but do you think that when this gets passed, we're going to see gold go on another run?
I think that's what we're seeing at the moment, is that, gold, has had a bit of a kind of up and down over the last few weeks, but, with the stimulus package, and I think, the activity across the board is part of this broader reflation trade. Like, that's what central banks want. Central banks want to see inflation in the market. They obviously don't want out of control inflation, but they want inflation. And so when you're seeing this kind of situation where the stimulus is coming out, obviously a lot of traders in the market, are supportive or like the fact that Janet Yellen is now in position as Treasury Secretary. And so this is seen as very positive, very accommodative from a monetary policy perspective. I don't think we're going to see interest rates rising anytime soon. And so in that kind of backdrop, you have an environment which is positive from a reinflationary perspective. And that's why I think people are investing.
Yeah, it seems like I worry about a lot of like my friends that are millennials. They don't have any. They don't have a lot of capital. They're starting out, and they just keep seeing asset prices fall further and further out of reach. I like here in the Toronto area, housing prices it just keeps getting stupider and stupider to the point where to go like buy like a 4-bedroom family home, you're going to need to either like basically be a doctor or
Yeah.
or have like a nice $600,000-700,000 down payment. So
But I
like
think, but I think this is something that not a lot of people are talking about. And you make a good point, Steve, because I say, I'm from Scotland originally, and growing up in the UK, the common sort of accepted wisdom was to say, okay, well, there's really two things you can do to generate or build wealth over your career. Number one, first paycheck, whatever you do, you have to save enough money and get on the property ladder. You have to buy real estate. And the second thing is, you get a good job, you work your career, and at the end of it, there'll be a state pension for you to retire on. And so let's take the first one first. The state pension, I think most people realize that that's not going to be anything to sort of write home about for the majority of people. And then property prices in the UK, probably similar to what's happened in Canada, but in most Western markets, where property is out of reach for people that are just starting their jobs or getting out of college. And so what does that mean? It means that the only thing you can do is invest in the market, because that's the really obtainable, accessible way to build wealth. And you can do it now with all the fintech apps for practically nothing.
yeah, that's a great point. I've never thought of that. Like last night, I had a couple buddies over watching the Super Bowl, and we had a few too many drinks. But one of my buddies said to me that his brother was buying this microcap stock that normally I'd never hear of, like a friend saying that their family member was buying a microcap or small cap stock, and it's just kind of like we're now seeing all this interest in these names here, and that's like they have this money. They can't put it in a home unless they want to buy a condo, which no one knows how that experiment's going to end.
Yeah.
So they're just going to park their capital somewhere. That's interesting. How much do you think social media plays a role now in terms of how institutions and large fund managers are deploying capital?
I still think it's relatively limited from an institutional investor perspective, because I think the majority of institutional investors, they have a process, they have a methodology that they follow. I think to the extent that it's kind of interesting around the edges, but I think it's still not at a point where people are kind of dogmatically following what's going on social media. There have been various attempts to incorporate social media feeds, etc., into alternative data feeds and feed that into a process. And I think some people have managed to have some success with that. But for the most part, I think it doesn't really play that much of a factor.
Okay. So last sort of thing I want to get into here is ETF investing. So a lot of young people, they don't want to be stock pickers, but they want exposure to the market. They sit down. There's a whole bunch of different ETF names they can look at. How should they sit down and evaluate? Let's put the macro aside. Just the structure of ETFs that are sensible, logical, attractive structures to invest in.
I think the first thing is to remember that ETFs, exchange traded funds, operate in a highly regulated market. So in the US, they have to conform to certain standardized structures. And from that perspective, the reason for that is because of the protections in place, from the regulations. So if it were me, I think, there are plenty of screening tools on there, like ETF database, people like that. But there are plenty of ETF screening tools that will allow people to search for particular types of exposures. For the most part, the structures are going to be very similar. There will obviously be some nuances when you get into the more, let's call them sort of unusual ETFs. But for the most part, equities and bonds are going to be the same type of structure. And then it's really just about what do you actually want to invest in, and making sure you're able to match what you're actually looking to invest in with the actual ETF.
But is there a huge variance in management fees, or like?
It can be.
Okay.
But like all these things, there's screening tools that you can stack and rank different funds, allow people to see the differences. But there'll be variances in performance, Steve, in terms of their returns they deliver, variance in fees, variance in the underlying components that they hold, the methodology of the index, lots of different variations.
Interesting. So I guess to me, how would GraniteShares how do you guys set yourselves apart from other ETF offerings?
So I think for us, we talk about three pillars of the business. On the commodity side, what we try to do is have the lowest cost, some of the lowest cost ways to invest in most popular commodities. So gold, broad commodities, and platinum, excuse me. And it's maybe something that's more of a US thing, but we have them with no K1. So that's a selling point to US-based investors or advisors where the particular structure doesn't generate a K1, which is popular. And then on the income side, we have an alternative income fund, which generates a very high level of income. But we do that by not investing in traditional dividend-paying stocks or by investing in bonds. And then that's a unique strategy, by the way, in the market. Then on the large cap equity side, again, another unique strategy whereby we aim to identify and score all the companies, top 500 companies in the US by market cap, and we exclude the 250 with the lowest scores. And so again, that's a unique strategy.
So investors who are interested in investing in any of your ETFs, they can just do it through their standard brokerage account.
Yeah, that's the beauty of an ETF, is that the relationship is, you're disintermediated, we're disintermediated from the client effectively by the stock exchange. But anybody looking to buy just needs to look in their brokerage account, type in the ticker code, and that's it.
Perfect. Well, Will, thanks so much for taking time to join us today. This was great.
Thank you so much, guys.
You've been very generous with your time here, and we hope that you'll come back and join us as this crazy world of stimulus. I'm sure that we're going to be talking about gold quite a bit and ETF inflows as we continue to paper over this gap in the economy.
Anytime.
Perfect. So Jay, let's quickly go through the news today. What's going on in the Canadian microcap world?